Today we're covering IonQ, a company building quantum computers at a moment when the gap between quantum potential and quantum reality is finally starting to close.
IonQ is a pure-play quantum computing company. That means it is not a division of IBM or Google. Quantum computing is the only thing it does, and it was the first quantum company to go public.
The company was founded in 2015 by two university physicists, Christopher Monroe from the University of Maryland and Jungsang Kim from Duke. Their specialty was trapped ion quantum computing.
Trapped ion is a specific approach to building qubits. Instead of superconducting circuits that need temperatures near absolute zero, IonQ uses individual charged atoms held in place by electromagnetic fields.
The claim is better qubit quality, lower error rates, and longer coherence times than competing approaches. That matters enormously for practical quantum computation, where errors are the core challenge.
In 2021, IonQ went public via SPAC merger on the NYSE, becoming the first pure-play quantum company accessible to public market investors. That listing brought capital and visibility, but also scrutiny.
On the business model, IonQ sells access to its quantum computers primarily through cloud platforms. Customers on AWS Break It, Microsoft Azure Quantum, and Google Cloud can run quantum workloads on IonQ hardware today.
Alongside cloud revenue, IonQ holds direct multi-year contracts with the U.S. Department of Defense and Air Force Research Lab. Government is both a revenue source and a credibility signal for enterprise sales.
Revenue has been growing fast. Annual revenue roughly tripled in the most recent fiscal year as more enterprise and government customers moved from experimentation to contracted deployments.
The company is still in investment mode. Operating losses remain substantial as it funds next-generation qubit systems and expands its engineering team. This is a pre-profitability growth story on the operational side.
The competitive landscape in quantum is unusual. IonQ's trapped ion architecture competes against IBM's superconducting approach, Google's quantum division, Rigetti, and a growing field of government-backed programs globally.
IonQ's differentiation is in qubit fidelity and its cloud distribution. Being available on all three major hyperscalers gives it a market reach that smaller rivals cannot match.
Geographically, IonQ's access points span AWS, Azure Quantum, and Google Cloud globally, plus direct on-premise deployments at U.S. military research facilities. European academic and enterprise partnerships are expanding as well.
On leadership, Peter Chapman became CEO in 2019, recruited from Amazon, where he led the Prime Air drone delivery program. He brought commercial discipline to a deeply academic founding team.
Chapman's background in scaling hardware programs from prototype to deployment is directly relevant. Quantum computing faces the same challenge, bridging lab performance and reliable commercial delivery.
He has pushed IonQ's IonQ Forte system toward enterprise deployments, expanded the direct sales team, and positioned the company as infrastructure, not just a research curiosity.
That positions IonQ well for what comes next. The Q1 2026 quarterly results are in, and the revenue numbers tell a specific story about whether that commercial momentum is translating.
We dig into the quarterly details in the full episode, what the revenue trajectory, contract bookings, and operational metrics mean for IonQ's path from quantum pioneer to quantum platform. Stay with us.
IonQ reported Q1 2026 revenue of $64.7 million, up 755% year over year, beating the $50.7 million estimate by 27.6%. Remaining performance obligations reached $470 million, up 554% year over year. Full year 2026 revenue guidance was raised to $260 to $270 million. This is Charged Alpha. I'm Hudson.
And I'm Lana. IonQ is the leading pure-play publicly traded quantum computing company. IonQ builds trapped ion quantum computers, systems that use individual charged atoms as qubits, and makes them available through Amazon Web Services, Microsoft Azure, and Google Cloud. IonQ also deploys hardware directly to enterprise and government customers. The company is headquartered in College Park, Maryland, adjacent to the University of Maryland quantum research ecosystem. Market cap is approximately $11.2 billion.
Niccolo De Masi became CEO of IonQ in 2024, bringing commercial and operational scaling experience from prior technology leadership roles. Damasi has accelerated IonQ's government contract pipeline and pushed the company toward direct hardware deployments, moving beyond pure cloud access toward on-site quantum systems at defense and research institutions. The strategic pivot toward recurring contract revenue is the core of IonQ's growth thesis.
IonQ's Q1 2026 revenue reached $64.7 million, 755% above Q1 2025. The beat against the $50.7 million consensus estimate was 27.6%. The adjusted EBITDA loss was $96.8 million, reflecting continued R&D and infrastructure investment at this stage of the business.
The GAAP earnings line requires context. GAAP EPS came in at $2.19, not an operational profit. GAAP net income of approximately $805 million reflects a one-time non-cash fair value gain on warrant liabilities and investment mark-to-market. The adjusted EPS loss of 34 cents is the operational metric, which missed the 22-cent loss estimate as IonQ invests ahead of revenue scale.
Remaining performance obligations, the contracted future revenue backlog, reached $470 million, up 554% year-over-year. RPOs represent signed contracts not yet converted to recognized revenue. At $470 million in backlog against $65 million in quarterly revenue, IonQ's pipeline substantially exceeds near-term recognition capacity and supports the guidance raise.
IonQ raised full-year 2026 revenue guidance to $260 to $270 million, implying approximately 100% or more organic growth. Q2 guidance was set at $65 to $68 million. The raise reflects existing RPO contracts converting to revenue as hardware deployments complete and cloud usage scales.
Contract wins driving Q1 include a $39 million Space Development Agency award for quantum networking infrastructure, a DARPA HARC contract, and delivery of a 256-qubit system to Cambridge Quantum, IonQ's most advanced commercial hardware deployment to date, confirming that trapped ion systems can scale outside IonQ's own facilities.
Cash at quarter end was approximately $3.1 billion, providing substantial runway against the adjusted EBITDA burn. At roughly $90 to $100 million per quarter in cash operations, the balance sheet supports multiple years of R&D investment and commercial scaling without near-term dilution pressure.
Analyst reaction to IonQ's Q1 was broadly positive on the revenue trajectory, with caution on the operational burn rate. The revenue beat of 27.6% and the RPO growth of 554% confirm that IonQ's government contract pipeline is converting. Goldman Sachs upgraded the stock to buy following Q1, citing the RPO trajectory as evidence of accelerating commercial adoption.
Bulls modeling IonQ on a revenue multiple rather than earnings multiple see Q1 as validating the path to profitability. At approximately $11 billion in market cap and $260 to $270 million in guided full-year revenue, the implied revenue multiple is approximately 40 times forward revenue, expensive by traditional software standards, but consistent with hypergrowth quantum infrastructure at the early adoption stage.
The adjusted EBITDA loss of $96.8 million for a single quarter concerns analysts who model the path to cash flow break-even. At the current burn rate, IonQ would consume roughly $400 million in adjusted EBITDA losses annually. Converting the full guidance midpoint of $265 million in revenue into positive EBITDA requires meaningful margin expansion, which IonQ management projects but has not yet demonstrated at scale.
The RPO metric is the key debate. Bulls argue that $470 million in contracted backlog, combined with the guidance raise, confirms IonQ is transitioning from lab to pilot stage to commercial at scale stage. Bears argue that government contracts are lumpy and that the revenue trajectory could decelerate if contract timing shifts or if competing quantum platforms win additional government awards.
Needham and Barclays maintained buy and overweight ratings respectively post Q1, citing the RPO growth and Cambridge deployment as milestones that de-risk the commercial scaling story. The consensus view among quantum specialist analysts is that IonQ remains the clearest publicly traded vehicle for quantum computing exposure, and the Q1 results demonstrated that the commercial stage is advancing faster than prior timelines suggested.
The bull case centers on the RPO to revenue conversion trajectory. $470 million in backlog against a $265 million full-year midpoint implies the pipeline exceeds near-term recognition capacity. As deployments complete and cloud usage scales, IonQ could exit 2026 with quarterly run rates that make the current $11 billion market cap look conservative on a 2027 revenue base.
The government contract moat is IonQ's durable competitive advantage. Defense agencies, including SDA and DARPA, have engaged IonQ as a primary quantum hardware vendor. Government relationships compound. Once a quantum system is installed, follow-on contracts favor the incumbent provider. IonQ's early positioning in defense quantum infrastructure is a long-duration asset.
Trapped ion architecture has a physics-based edge in error rates. IonQ systems deliver lower gate error rates than superconducting quantum computers at comparable qubit counts, which matters for practical quantum advantage workloads. If that superiority holds at higher qubit counts, IonQ's technical differentiation becomes a sustainable moat.
The bear case leads with the operational burn rate. $96.8 million in adjusted EBITDA losses per quarter against $64.7 million in revenue means spending roughly $0.50 per revenue dollar. Even with $265 million in full-year guidance, the path to EBITDA break-even requires step function revenue scale, which is not guaranteed.
IBM and Google are the competitive threats. IBM's superconducting systems have more mature cloud software ecosystems and larger qubit roadmaps. Google's Willow chip demonstrated quantum error correction breakthroughs. If superconducting architectures reach trapped ion error rates at scale, IonQ's technical moat narrows and bears model that convergence within the bull case timeline.
Government contract concentration is a risk. The revenue surge was driven by a small number of large awards. If timing shifts, a single delayed contract could cause a quarterly miss. Government procurement lumpiness means IonQ's quarterly revenue can be volatile even if the annual trajectory holds.
Dilution risk is structural. The $3.1 billion cash balance was accumulated through prior equity raises. If the profitability timeline extends, additional equity or convertible debt offerings could pressure per-share value even as enterprise value holds. The share count of approximately 291 million could grow meaningfully over the next 2 to 3 years.
IBM is IonQ's primary enterprise quantum competitor. IBM's superconducting systems are available on IBM Cloud and through direct enterprise deployments. IBM has published roadmaps targeting error-corrected quantum advantage by 2029, competing directly with IonQ's scaling timeline. IBM's quantum program benefits from broader cloud and enterprise software integration than IonQ currently offers.
Rigetti Computing and Quantum Computing Inc. are IonQ's publicly traded pure-play peers, both significantly smaller in revenue and market cap. Rigetti uses superconducting architecture and has struggled to convert government contracts into sustained growth. IonQ's revenue trajectory is substantially stronger despite both companies competing for similar government quantum awards.
Google and Microsoft operate quantum programs as strategic investments. Google's Willow chip demonstrated error correction breakthroughs in 2024. Microsoft pursues topological qubit architecture. Their research programs represent long-term competitive threats if commercialized before IonQ achieves fault-tolerant scale.
On valuation, IonQ trades at the highest revenue multiple among publicly traded quantum names, reflecting first-mover advantage, government contract pipeline, and RPO growth. The premium is justified if IonQ delivers sustained triple-digit revenue growth through 2026 and 2027. The multiple compresses quickly if growth decelerates or the adjusted EBITDA burn does not narrow as revenue scales. That trajectory justifies patience at the current valuation.
IonQ's options market ahead of Q1 showed elevated implied volatility, consistent with the binary outcome risk of a company with large contract timing uncertainty. Pre-earnings positioning skewed toward calls, reflecting expectations of a revenue beat given the prior RPO trajectory. The post-earnings stock gain of approximately 8.5% was within the implied move range.
The GAAP EPS of $2.19 briefly confused the market. Once the one-time non-cash nature of the $805 million net income was clarified, traders focused on the adjusted EPS miss of 34 cents versus the 22-cent estimate and concluded that the revenue beat and RPO growth were the primary valuation drivers supporting the stock's gain.
Insider activity at IonQ reflects the typical pattern for a high-growth technology company. CEO Niccolo de Masi holds substantial equity in restricted stock units vesting on performance and time-based schedules. No significant open market purchases were reported in the most recent 90-day window. Executive 10b5-1 plan sales reflect systematic diversification at elevated prices relative to historical grant prices.
The combined read is neutral to positive. Options correctly anticipated a revenue beat. Executive equity aligns management with long-term revenue and RPO growth over near-term GAAP profitability. For a company at IonQ's stage, the question is whether the technology is commercializing ahead of competitors, and Q1 suggests yes.
IonQ's Q1 revenue beat consensus by 28% on 755% year-over-year growth. The GAAP gain was non-cash. The real story, $470 million in RPO backlog and a full-year guidance raise to $265 million.
Bottom line, IonQ is the leading pure-play quantum name in public markets. Revenue is real, the backlog is real, the pipeline is converting. Bear case, cash burn, and IBM or Google competition. Bull case, trapped ion moat at the dawn of commercial quantum advantage.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall